Hi, everyone, and welcome to the Strategic Wealth Strategies Podcast with our host, Alan Porter. Alan, what's going on, man? How are you?
Good. How you doing today, Neil? Great
Uh,
day here in North Carolina.
a fantastic day here in Texas as well. And what is our topic for today?
Well, it's about, especially for people coming close to retirement, are you ready to ride the stock market with the volatility that's involved in it? And I prepared a short PowerPoint presentation. Give me a minute. Let me share my screen.
Okay.
I will start it from the beginning.
All right. Should you ride out the stock market? Making sense. And as the topic, as you're about to jump into that in a second, good topic, Alan, that's for sure.
Yeah, I'll tell you what, the way the stock market is going, it's
It's,
pretty scary.
it's definitely scary, and especially what's happening in our country for sure. Okay.
All right, can you see all this?
Yes, I can.
All right, let me put this back a little bit. Let me put back. Let's put it up. Let's put it up here at the top. All right. Should people ride out the stock market, especially when it comes to the volatility that's involved in it? Now, I've got people. Well, all the pundits say, invest in the stock market. It's going to give you the biggest gains over the years. Well, let me tell you what. The S&P just got back to what it was 2 years ago, but I've got some points to bring up about that. Both the Dow and the S&P 500 were back to where they were 2 years ago as of May 31st, and it's been stomach turning roller coaster all along the way. But understand this: it has gone up a tier, maybe 10% this year, but look at your investments and retirement account balances and wonder why you're not seeing that kind of gain. Because 96% of those gains were caused by five technology companies, and people don't understand that. Market Watch just called the S&P 500 ridiculous and questioned whether you should bet on your retirement on the fortune of a small handful of stocks. And
Mm.
I completely agree. Of course, this is the financial expert advice that the only way to grow your sizable nest egg is to invest in the stock market over a long period. Well, here's the thing: the people that are telling you this, Neil, their stock and bond portfolio, they get a fee whether you make money or not.
Hmm.
And I tell people, I said, let me ask you a question. They call themselves fiduciaries, but how can they call themselves a fiduciary when I introduce a product to them that only needs 2/3 of that stock market portfolio to give you guaranteed income at a 4% distribution rate, and they tell them not to do that. And that, from what I'm talking about, that's guaranteed for life too. You can't do that with the stock market. So how can these people call themselves fiduciary? And again, they make a fee whether the client makes money or not. And I used to be a registered investment advisor, but I got a conflict of interest. I don't do that anymore because I don't like charging a fee whether I make money or not. So I ask people, is this really true? And I'll absolutely tell you it's not true. There's many ways out there, but people have to think outside the box of conventional financial planning. You know, the typical investor, earns a meager 4.3% annually after adjusting for inflation. And the other thing people don't know, yet most people we surveyed said they wouldn't endure the ups and downs for less than in a market for less than 7%. Investors who use asset allocation long consider a strategy that gives you the best chance of coming out ahead have essentially no growth over the past 30 years after adjusting for inflation. And if you thought fixed income investments were a safe bet, think again, they've actually lost ground even before factoring the inflation. And these statistics are from the Dalbar quantitative analysis of investment behavior, and it paints a very sobering picture. It's a stark reminder that the stock market is dangerous. It's dangerous money that you're counting on for a secure retirement, funding for college, and other financial goals you have set. There's no guarantees with the stock market. You can lose 50% in a couple of days, just like back in 2008. And
Mm.
another thing people don't understand, Neil, if you lose 50% in that market, it takes 100% gain just to get back to even.
Mm.
Now, here's just a couple of things that the volatility may stay thanks to the economic headwinds we're facing. Public traded companies' revenues are sliding, inflation remains stubbornly high, lending conditions have tightened significantly. We've had many bank failures already this year, and recessions over the past 30 years have closely tracked banks' willingness to lend money. They're not lending money like they used to, and China's economic troubles could have significant consequences for the markets and growth in the U.S. And a couple that's not on here, Neil, the national debt. You know, we've got a $31 trillion, well, actually, it's more than $31 trillion. And there was a congressional budget office report that was put out last fall, just on a debt of 31 trillion. If we do not raise taxes overall by 66%, we can't even pay the interest on the debt that we have. The country will go bankrupt. So what are they doing? They're raising interest rates. They're printing more money, causing massive inflation. We've had the highest inflation we've had in 40 years. The other thing is fuel prices. That's one of the things causing inflation. And because, you know, they want this green energy deal. That's all well and good. But they all want it all at once. It can't happen. It's just like farm equipment. You know, what are you going to do? Wait 24 hours for it to charge up so you can go out and plow your fields?
Right.
I mean, it's not going to happen.
Nope.
And it's economically not feasible for it to happen. But the thing is, if prices go up in fuel, they go up for everything. I don't care whether it's food, whether it's consumer goods, or anything else. Now, understand this. This is really scary for people. At the same time, consumer debt has skyrocketed, averaged over $101,000 per household. And meanwhile, their savings has dropped precipitously. And what I show people is how to eliminate debt, eliminate possibly taxes altogether. And when we eliminate debt, we eliminate the compound interest cost, the effective interest costs that people pay into financial institutions. And they have no idea what I'm talking about. And I asked this guy that I did a program for, I said, what's your interest rate on a mortgage? He said, it's 2.75. I said, I want you to fill this form out and send it back to me. I said, you got $461,000 in debt. That is not your problem. Your problem is the effective interest cost you're paying on all your debt. The effective interest cost on your mortgage is 49.76%. He said, how is that even possible? I said, well, because it's not going to get down to the 2.75 until the last couple of months of the mortgage. He said, I said, the problem is you got good credit, but your average effective interest cost on all your bills is 46.23%. And he said, I said, what financial vehicle are you investing in? A 401k or a stock portfolio that you get a 46% rate of return? Because 46 cents of every dollar that you spend goes to compound interest for the financial institutions and not for yourself. He said, well, I just didn't know. I said, well, let's take that $1,000 you're putting in that 401k and let's put it in this program for 10 years. And then I asked him, I said, how long would it take you to pay your debts off the way you were going? He said, 20 some years. I said, okay, we're going to pay your debts off in 14 years. We're going to save you $76,000 in interest and put $130,000 in a tax-free account and a $400,000 death benefit. Now, this account we set up for is what I call an SDIC. It's a specially designed insurance contract. And we set it up in a way that'll get people out of debt. And, you know, Dave Ramsey gets you out of debt. But the problem is Dave has you pay the information. I mean, the extra payments to the financial institutions, compounding for them and not for you. But what we do is we set this SDIC up and take that money that Dave Ramsey was putting towards these financial institutions to pay off bills, and you put it in a tax-free bucket of money that compounds for you year after year. But that's another story that I have for people, and I can talk to them about that after this presentation is over. But don't let market volatility dictate your destiny. I tell everybody, you have the power to take control of your future, your financial future. I spoke at Harvard back in 2017. There's about 150 people there. And I told them, I said, they were doctors, CPAs, top attorneys, everything, business owners. I said, I can change your financial future with my strategies and products, but I challenge you to take charge of your financial future and have liquidity, use control of your money. And I showed them a few things. But the thing is to think outside the box of conventional financial planning. Now, this is what I show people. And they say there's no such financial vehicle as this. What if I could show you a financial vehicle that has the following benefits and many more? Lets you leverage our progressive tax system, turn forever taxable money into never taxable money, provides you with long-term care options that are tax-free for pennies on the dollar, provides you with tax-free income in retirement and before retirement. You can't do that with a stock portfolio in a 401k. If you take it out before 59 and a half, it's a 10% penalty. Plus you have all the taxes to pay on it. And the taxes are going to be higher than they were. They were in the lowest tax bracket we've been in 70 years, Neil.
Mhm.
And another thing, it protects you from the taxation of Social Security and the means testing from Medicare Part B, which is going to be in the thousands of dollars. And I'll give you a quick Reader's Digest view of this. Let's say that you're married at age 65 and you make $44,000 or more in income from a 401k, a pension plan, or something else like that. All right. You get $3,000 a month in Social Security. 85% of your Social Security is going to be taxed. Right now, in the lowest tax bracket we've been in 70 years, that puts you in the 12% minimum tax bracket, 10.13 effective tax bracket, because we have a progressive tax system. You're writing a check to Uncle Sam for over $6,000 every year for the rest of your life, provided taxes don't go up. It protects you from market losses, all the while giving you the ability to take advantage of a market loss because you can borrow from yourself in your cash value policy. And it's not just cash value life insurance, it's fixed and fixed indexed annuities too. You can create a legacy for your children or your beneficiaries that's tax free. And I tell it's like Tom Hagner says, spend your assets, give your children tax free life insurance. You can divide that up equally. And people aren't arguing, are we going to keep mom and dad's house or are we going to rent it out or whatever? It stops a lot of arguments. It protects you from lawsuits, liens, and judgments. You become your own bank, paying yourself compound interest and not the financial institutions. I'm going to give you a real quick example. Let's say that you have $50,000 built up in this SDIC, specially designed insurance contract, and you want to spend $30,000 for home renovations. Now you can go to the bank at 0% interest and get a loan for 3 years. You're paying $10,000 a year for 3 years. And at the end of 3 years, you'll have all your renovations paid for, correct? All right. But the problem is you've lost that $30,000. It's going to compound for the financial institutions for years and years and years, but it's never going to compound for you again. So what you do is you take that $30,000, you borrow from yourself in that SDIC, and then you pay yourself back $10,000 a year. Not only will you have your renovations paid for, Neil, but you have this $30,000 that you paid for the restoration. And also, because it's a non-direct recognition company, this whole life policy, they have to pay you dividends on the original $50,000. Plus, you have a death benefit, which is in the hundreds of thousands of dollars that you can use for long-term care tax-free or protect your beneficiaries. Now, people don't understand this, and it's not rocket science. It's stuff, like I said before, it ought to be taught in high school. But I've said this before, I've got doctors who have PhDs in accounting and finance, and they know nothing about what I talk about. If any of this would interest you, from becoming debt-free, becoming tax-free for life, extending your financial future, securing your financial future, protects you from the risk in retirement. The number one fear in retirement is running out of money before you run out of life. I can show you how to eliminate that. Longevity risk, which is a risk multiplier. I can show you how to eliminate that. Sequence of returns risk. Many people don't know what this is, but if you have a loss in the first 3 years of your retirement, when you start taking money out, your retirement is going to be decimated. I can protect you from this and many, many other risks in retirement. So if you'd like to talk to me, here's my information, 910-551-1046, or you can email me at strategicwealth0@gmail.com. And there's my website down there also. But I hope I got through to some people in here to open up their mind to think outside the box of conventional financial planning, because it makes a huge difference in people's lives.
Great information, Alan. Again, looking at all these options that are better than just, waiting for the stock market to get better. Definitely got to contact you today.
Well, I appreciate it, Neil.
All right, Alan. All right, that was the Strategic Wealth Strategies podcast, guys. Take care.